What's the difference between whole life insurance and IUL, Indexed Universal Life? I've been asked that question thousands of times. This episode will explain why I prefer IUL over whole life. If your objective is living benefits, you want to accumulate your money at the best net internal rate of return tax-free, and then turn on tax-free income with the highest net spendable tax-free income, and all the way to age 120 without depleting your nest egg or your cash value. I'll prove in this episode that a properly structured max funded IUL will far outperform whole life, because IUL, or universal life, was designed primarily for that purpose, living benefits, compared to whole life, which was primarily designed for death benefit, with guarantees to make sure the death benefit stays in force, okay? I'm going to prove to you in this episode, if you do it right, it is a superior vehicle for that purpose, so get ready. So I'm Doug Andrew. I've been a financial strategist and a retirement planning specialist now for 5 decades, helping thousands of Americans optimize their assets, minimize taxes, and empower what I call their authentic or true wealth. If you've watched very many episodes on this channel, my favorite financial vehicle without question for living benefits, tax-free accumulation of your money, tax-free income, is a properly structured, max-funded, indexed universal life. And if that's your objective, you're going to understand here why whole life, in my opinion, doesn't hold a candle. Whole life was not designed primarily for living benefits. Can you use it for living benefits? Yeah. But if your main objective is living benefits, Index Universal Life is a far better choice, and you'll see why. Even though you could use whole life for, tax-free access to money and tax-free income, you won't generate as much, and I'll explain why in this episode. So let's first of all talk about the concept of living benefits. Now, most people in my career have come to me because they want to put their money, they want to reposition their serious cash into the best financial instrument or instruments that will do what? Okay. It's for living benefits. They want to not outlive their money in retirement. Okay. Or maybe college funding or business working capital or the banking concept or whatever. Okay. So usually people are intrigued because life insurance helps eliminate the 3 big dangers that cause most retirees to outlive their money: taxes, inflation, and market volatility, okay? And so if you properly structure or max fund life insurance, in order to eliminate those dangers, you're seizing 3 opportunities, okay? You're converting to tax-free vehicles, because permanent life insurance, the money that grows inside of those is tax-free. And at the end of the day, when you die, the death benefit is tax-free, okay? Nothing else in the Internal Revenue Code allows you to accumulate your money tax-free, access that money tax-free, and when you die, it blossoms, it increases in value, and transfers income tax-free. When you understand indexing, you can link your returns to the things that sort of inflate, okay? I don't like inflation any more than anybody, but it doesn't hurt me. So I come along for the ride. I can outpace inflation by diversifying and rebalancing. And then by using indexing, I participate when the market goes up, but I don't lose when the market goes down. The reason why life insurance, property designed and structured, is my favorite vehicle, and if it is, it qualifies to be deemed a laser fund, is liquidity. That's the number one rule of a prudent investment. You want to have access to your money when you need it, okay? Without 10% penalties, triggering tax, and what have you. You want to have safety of principle, not only of the institution. Insurance companies are they're probably the safest institutions in the country, but safety of your principle. Whatever I set aside, I don't want to lose. And any year that I make money, I want that gain to become newly protected principal. I don't want to lose in future years money I made in previous years. A lot of products can't do that. And then to earn a predictable rate of return that historically has outpaced inflation. It doesn't have to be pie in the sky rates of return, even though some years our clients get credited 25%, 61%, 158% and more. The average return is usually in that 7 to 10% range net cash on cash, and even higher. And I'll prove that to you. Okay. So with that in mind, if we look at the benefits of permanent life insurance, whether it's whole life insurance or universal life, when E.F. Hutton, who was the brainchild behind the emergence of universal life back in 1980, and then the emergence of indexed universal life in 1997, they realized in 3 sections of the Internal Revenue Code that now for over a century have been sort of sacred tax-free, cash cow accumulation access vehicles, okay? Briefly, Section 101A of the Internal Revenue Code talks about that any time you own life insurance, permanent life insurance, or any life insurance, when you die, that death benefit is income tax-free to the heirs, okay? Now, while you're alive, the money that accumulates inside your permanent life insurance policy, the growth, interest, dividends, or whatever, is tax-free under Section 72E of the code because the government doesn't want to hurt people who are trying to take ownership, whether they live a long time and want to take tax-free income or whether they die prematurely and leave behind widows and orphans. If they're trying to take pressure off of the government to take care of these people or take care of people in retirement, they don't want to shoot themselves in the foot. So they said, let's give them tax-free accumulation. Section 7702 of the code says how or what rules you have to abide by to be able to access money tax-free out of permanent life insurance, okay? So those 3 sections of the code, E.F. Hutton said, golly, life insurance is incredible. But instead of whole life, which was primarily designed for death benefit, E.F. Hutton back in 1980 said, well, why don't we design insurance primarily for living benefits, and we can actually get away with less life insurance than the IRS requires under whole life, and we can get more money in faster, so therefore the costs are going to be less. The biggest problem whole life agents make is they're trying to compare apples to oranges when they think they're comparing apples to apples because they're always looking at the death benefit. We're not talking about the death benefit. Most people that have come to me didn't really want or need more life insurance death benefit. What did they want? They wanted a vehicle where they could put money and accumulate it tax-free and get the highest amount of tax-free income during their life. It's called life insurance. Most whole life agents are using it for death insurance, okay? So they came out with universal life in 1980, which basically meant that when a person came and if they wanted to reposition, $10,000 a year, $100,000 a year, $500,000 in one fell swoop back in 1980, we just calculated the minimum amount of insurance required. You could buy a ton of life insurance for $500,000, but that's not the objective. You wanted the least amount of insurance that you could get away with, okay? And so these tax citations in 1982, the Tax Equity Fiscal Responsibility Act, and then the IRS didn't know what they were doing when they went to Congress, so they had to redefine it 2 years later. This was 1982, 1984, is DEFRA. That's a Deficit Reduction Act. Simply put, the TEFRA-DEFRA tax citations or corridor dictate under Section 101A of the code how much life insurance has to be in the policy attached to the account so you do not exceed the definition of tax-free accumulation of money and death benefit. If you violate that, then you move from tax-free life insurance to taxable investment section of the Internal Revenue Code. And investments are taxable sooner or later, and they're usually subject to market volatility. I don't want an investment if that's how they define investment. I want tax-free growth of my money under Section 101A, okay? Now, so that's what they dictated, and I'm going to come back and show you the power behind what this means. Then in 1988, there was a massive exodus of money leaving the banks, the brokerage firms, credit unions into these because they were safer. They paid higher interest. They were tax-free. They blossomed when you died. And so they couldn't compete. And so they didn't want to kill them because this is where banks and credit unions, brokerage firms put 30 to 40% of their tier one assets for liquidity and safety. In BOLI, bank-owned life insurance, okay? And so they didn't want to kill it. They just wanted to slow the flow of money because people were just transferring $500,000 on one fell swoop. And so they said, just slow the flow. So they passed under the Technical and Miscellaneous Revenue Act, what is called TAMRA. If you violate TAMRA inside of a whole life or inside of a universal life, if you violate TAMRA, it becomes a MEC, a modified endowment contract. The money still grows tax deferred under Section 72E. But if you start taking out money out of the policy under Section 7702, it's now taxable, LIFO, last in, first out. Most people came to me, not for the death benefit. They wanted tax-free income. So to comply with 7702, you have to comply with TAMRA. TAMRA with whole life is also synonymous with 7-pay. If you wanted to put in $500,000 into a whole life policy, you had to put it in 7 payments. It took 7 years. Technically, the first day of the first year. So after 6 years and 1 day into the 7th year, you could get the $500,000 into a whole life policy to avoid a MEC. 7-pay is a misnomer with regard to universal life and indexed universal life. For somebody over age 50, I could get the $500,000 into the IUL policy in 4 years and 1 day. If you're under age 50, in 3 years and 1 day. And now, since recent passage, I can get by with even less insurance with universal life, indexed universal life, and I can get in the money maybe for a younger person in as little as 2 years and 1 day. An older person, 3 years and 1 day. I can get most of the money in there, if not all of it. So TAMRA under 7702, I can actually get my money in faster, which means the money's going to start growing better. And I can get away with less insurance under TEFRA and DEFRA. So let me show you what this means. I've often compared a permanent life insurance policy to like a bucket. So whether it's whole life or universal life, if somebody comes to me and they want to, reposition $10,000 a year, $500 a month, $100,000 a year, $500,000, TAMRA says that under universal life, I can get it in there if you're, over age 50. First day of the first year, 4 years and 1 day into the 5th year, I can get the money in there. I've complied now, and my money will grow tax-free. I can take out tax-free income. I can have the cost of the insurance, which is the spigot on the bucket, which is really not a cost. It's actually watering a nice little money tree at the end of the day that's going to blossom into a death benefit. Now, I'm going to share something right now that most whole life agents don't understand. You ready? Okay. So let's use a scenario here. Many times I'll say to a whole life agent, let's take a male age 60. I want you to show me a whole life policy, and I want you to structure it so it will accommodate $500,000 of this person's money into a whole life policy as fast as the IRS allows under TEFRA and DEFRA, with the least amount of death benefit. Now, basically, I'm going to round the numbers here. With IUL, if somebody comes to me at age 60 and they're in decent health, they can get that $500,000 in there, and the minimum amount of insurance is only about $1 million. I can get way more life insurance than that for $500,000. That's not my objective. I can get away with $1 million of life insurance. Stay with me. I'm going to show you how significant this is. If this was whole life, most whole life agents will go, let me use the same death benefit. And they want to compare, they think that's apples to apples. No, the objective is living benefits. So I want the whole life agent to take $500,000 and show the least amount of insurance they would have to have under whole life. And it's going to be $1.2 million, $1.3 million, $1.4 million. It's going to be way more life insurance. It's going to be way more expensive. The spigot on the bucket's going to be higher. Hello? So you're not comparing death benefit. You're comparing how fast can I get that money in under that, and what's the least amount of insurance I can get away with? You get away with less insurance with IUL, okay? Now, under TAMRA, I'll be able to get in for that male age 60. I'll probably now be able to get in maybe $125,000 the first day of the first year. Another $125,000 the first day of the second year. 1 year and 1 day, I have half my money in there, $250,000 in there. On the third year, 2 years and 1 day into it, I've got another 125,000 in there. And so in 3 years and 1 day, or a little bit in the fourth year, I've got my $500,000 in there. Whole life, it's going to take me 7 payments or 6 years and 1 day to get that $500,000 in there. So, hello, if I get away with less cost, less insurance with IUL, and I get my money in a lot faster, which one's going to outperform if everything else was equal? Now, in actuality, I actually earn a higher rate of return by diversifying and rebalancing with IUL than whole life. But if the rates of return were the same, I'll knock the socks off of whole life. Now, here's what most whole life agents don't understand. They think, that universal life, IUL, is going to crash and burn. The cost of insurance is going to get so expensive at the end of the day. They tout whole life. Well, it has guarantees. The death benefit is guaranteed your whole life if you'll pay these premiums. No, why do I need to worry about guarantees of death benefit? Okay. They say, well, it has to still be a life insurance death benefit at the end of the day. Indexed Universal Life has no lapse guarantee riders that just come along for the ride at no cost, that this policy, the death benefit will not lapse if you live to be 120. But if you structure it the way I'm talking, see, this money that's going into here, I put in my money in compliance with TAMRA, okay? Now, in 4 years and 1 day, let's say I have my 500,000 into the IUL. Whole life is still taking a few more years to get it in there. This 500,000, I don't care about the death benefit. As I put in 500 grand, it actually qualifies as part of the original death benefit because I'm taking the level death benefit. So if I die, the insurance company's going to still pay out $1 million, but $500,000 of that was my own money. Hello? So in 4 years and 1 day, half of the million, if I die, is just my own money. So how much is the insurance company charging me in 4 years? Only for the net amount of risk, that the remaining 500,000. They don't keep charging me for $1 million of insurance because they're not on the hook for that. They're only on the hook for the difference between my cash and the original death benefit. I've earned at least 9.62% average rates of return since 1980. 9.6 divided into the rule of 72 means your money's going to double every 7.5 years. That means in 11.5 years in this example, my 500,000 is going to be equal to the $1 million. Now my cash value has grown to equal the death benefit. What's the cost of insurance? Why do I need guaranteed $1 million of life insurance when my death benefit is $1 million because my cash is $1 million? You can't believe how many whole life agents get a deer in the headlight. Look, when I say this, okay? They don't understand this. And then, that $1 million of cash value can generate $100,000 a year of tax-free income. Or if I don't need the money, that $1 million will double in another 7.5 years to $2 million. Now, technically speaking, under TEFRA and DEFRA, if I happen to die, TEFRA and DEFRA says that the insurance company will pay out 5% more. So if I had $2 million of cash and I died, the insurance company is going to pay out $2.1 million, but they're only charging me for $100,000 of net death benefit. The cost of $100,000, even though I'm 17 years older in this example, the cost for $100,000 of insurance, the spigot on the bucket, is so minuscule compared to the interest I'm earning that year and every year on the $2 million. It's like the insurance is getting cheaper as I get older. In the 20th year, if I earned 11, I'll probably in that year net 10.95. But retroactive back to day one, if I average 11, I'll net 10. Okay. You'd be lucky with whole life to earn 8 and net 5.9 by age 95. I have seen numerous whole life policies, and the net internal rate of return, cash on cash, rarely gets within 2% of the gross rate of return. It takes till age 95 to do that. We achieve that by age 65 or 70, and depending on if they just started at age 60. And the net internal rate of return is usually within 1% of the gross rate of return, retroactive back to day one. Okay. So, this is what I would recommend. if you want to compare whole life to IUL, this is how you ask an agent or the company to create a scenario. Determine the scenario to compare max funded IUL to max funded whole life for the purpose of living benefits, okay? You're wanting to use tax-free income. You got it? So the example, let's say I want to see a male age 60 repositioning $500,000. That's the money you're going to put in. Calculate the least death benefit with whole life under TEFRA and DEFRA tax guidelines. What's the least death benefit? And I assure you it's going to be more than the death benefit required for IUL. Max fund that whole life as fast as TAMR allows to avoid a MEC. They will not be able to put in as much money as fast as IUL does, okay? Pick an age. If we did 60, age 70, or if you're starting at age 35, maybe age 65, pick an age to illustrate the maximum tax-free income to age 120 without lapsing the policy, okay? You got it? So show me, starting age 70, how much I could pull out of that whole life policy tax-free without it lapsing to age 120. I guarantee you the income out of whole life will not even be close to the income you can generate out of a max funded IUL. And make sure they use actual historical rates of return based on diversification and rebalancing. If you structure IUL properly, you will diversify and rebalance annually if you work with a certified IUL professional. And so that's how we are able to earn average returns of 11 and net 10 by doing that. Whole life, you might be lucky to earn 8 and net 6, okay? So that's basically the difference. So folks, if you want to learn more, of course, you can go to laserfund.com and contribute a nominal amount towards the shipping and handling. And I'll pay for this 300-page book, The Laser Fund, and fire out a hard copy to you via priority mail. I require a little bit of skin in the game, and you will learn a ton. So to learn more or take a deeper dive, hear a different perspective, click on this episode here to learn and understand more.